Markets in turmoil, what happens next? Yesterday, the market sold off sharply because of the Fed minutes coming out saying they're going to reduce their balance sheet faster than expected, taking away the punch bowl for the markets. The sell-off yesterday certainly got investors' attention, but let's put this into perspective first of all. Looking back at a chart of the market going back to March of 2020, this is the correction that we saw yesterday, well within the context of the norms of the bullish trend that we've been in since March of 2020. Absolutely nothing has changed here. Market was overbought, as we discussed yesterday, a pullback to the 50-day moving average, certainly well within the context of normality. But is this time different? That's the question. In yesterday morning's video, we discussed the fact the market was acting very normally to what we had seen previously. A rally where the market then began to consolidate, a retest of the 50-day moving average, another rally that consolidates and a retest of the 50. This is something that we have seen repeated throughout the year, last year in particular. And so yesterday we actually spoke about the fact the marketed rally was consolidating and we were expecting a pullback to the 50-day moving average because that's the way the market's been behaving for a while. Now, yesterday morning, we sold off our trading positions in S&P and again, reducing our equity exposure to the markets because of this overbought condition and the fact that our money flow indicator was starting to peak and roll over here. So again, there was already some indications that the market was preparing for a sell-off. Now, this was before the Fed minutes were released, but the markets were already sensing something in the marketplace. The question now, though, is the sell-off over or is there more to go? Most likely, we're going to see a little bit more sell-off here over the course of the next couple of weeks. Now, that's not going to happen immediately. I would certainly expect the markets to try to hold support here at the 50-day moving average, maybe even potentially bounce a bit before trying to come lower and test the lower range of these Bollinger Bands. And again, this is going to be an adjustment process for the markets over the course of this month. As we've talked about typically in Januaries tend to have about a coin flip of being either positive or negative. I suspect we're going to see a negative January by the time this is all over. We'll be watching, but again, watch the fact that our money flow indicator is about to trigger a sell signal that would suggest more downside risk to the markets. That doesn't mean, again, markets go straight down. They could, but look for a bounce to potentially to reduce risk into, reduce positions that have been underperforming, areas of beta high growth. You want to start to maybe reduce those. Look more towards value temporarily to hedge risk in your portfolio overall, but look for this decline to a lower level. Now, if that occurs, I certainly expect to see the Fed maybe talking about slowing their rate of taper, potentially slowing their rate hikes, and that'll probably show up in the next meeting, particularly if the market does get into more trouble. But we're already starting to see some of the economic data peaking here, particularly with the inflationary data. That may pull some pressure off of the Fed to hike rates as fast and to remove the taper as quickly. That would bode well for the market. So again, don't be too aggressive in selling off in the markets, because likely we're going to see a change of stance in the next month or so. We'll see, but we'll keep you updated on this right here on 3 Minutes of Markets and Money. See you tomorrow.